Now, if you have seen image of the world's richest man, Elon Musk, jumping around and goofing around at Donald Trump's presidential rallies, you may be tempted to see a man who is distracted from his main business. When Tesla reported their Q3 report, earnings report on Wednesday, none of those antics mattered, as Tesla simply delivered what I would describe as an impressive performance. Now I'm here to break down this result to you, and I know you can't wait to have it. It was not only Tesla that published their Q3 report last week. We also saw reports from Enphase Energy, NextEra Energy, Thermo Fisher Scientific, Verizon Communication, Coca-Cola, Airtel, Stanbic IBTC, and Dangote Cement, among a host of other companies. So when you hear this sound, you know it's time for market tape. And I do this every Monday morning to keep you updated with the Nigerian and global capital markets. If you've been on this show, if you've been enjoying what I'm doing, don't hesitate to subscribe and activate your notification button so that anytime, as soon as my episode drops, you'll be the first to hear it. Now, before I get into the business of the day, I always like to make this disclaimer that this show is for information purposes only. Nothing said on this show is an investment advice. Before using any of my insights, you want to make sure that you are accounting for the risk that is involved in investing, which you need to take into account before investing. I would advise that you work with a licensed professional to guide you before putting any of these insights to use. Actually, there's a lot to unpack today. I don't even know how to get started with this. There's a lot. We saw a lot of earnings reports last week. But before I get into earnings reports, we saw last week one of the world's largest asset managers, Goldman Sachs. They published a report which claimed that there is a 72% chance that bonds will outperform equities in the next 10 years. And the reason they advanced for this position is that currently the market is has reached a level of a level that you say is overvalued, and so they think that we can't sustain this. Again, they also thought the market is over concentrated at this point in time. Shortly, I'll be. This week we're going to see a couple of earnings reports come out. Five companies that will be reporting this week are members of the so-called Magnificent Seven. And speaking of Apple, Amazon, Microsoft, Google, and Facebook, now called Meta. These 5 companies will be reporting this week. And these 5 companies on their own constitute almost 24% of the S&P 500. Just 5 companies account for 24% of the S&P 500. So Goldman Sachs is looking at this sort of situation, and they're saying that the market is concentrated in just a few stocks. Basically, just a few stocks that have been driving the returns that we've seen in the last couple of years. And they think these past 10 years, in fact, has been spectacular. In the last 10 years, the S&P 500, for instance, has done a return of 13% on an annual basis. 13%. That is a bit higher than the long-term average for the S&P 500, which is 11%. So Goldman Sachs is saying that because of the level of concentration that we're seeing, because of the level of the current level of valuation, they're expecting that that level of return cannot be sustained. And by their own estimation, we're going to average about 3% in the next 10 years. And if that happens, it will be a big disaster for investors in the stock market, because the S&P 500 over the years has been seen as a vehicle for actually accumulating and growing wealth and actually preserving wealth. One of the best way you can you can grow your wealth is through investing in equities. But by this report, Goldman Sachs is saying that in the next 10 years, it's going to be we're going to see a downturn in the level of returns at the level that we've never seen, and 3%. So for me, it's a very audacious prediction. We also saw a kind of conflicting report last week from JPMorgan. JPMorgan was a bit more bullish in their estimate, and I think they estimated about 6.7% growth in the S&P 500. So my question is, do these predictions really matter? How should you take them into account when you are making investment decisions? How much attention should you be paying to predictions like this? Speaking of predictions, you also saw sort of downward revision from IMF regarding the GDP growth rate for Nigeria. They revised the growth rate for Nigeria downward to 2.9% for 2024 and then to 3.2% for 2025. Now, speaking of predictions, I think there's an interesting thought that I want to share with you guys regarding what Warren Buffett says about economic predictions. Take a listen to this.
In terms of the potential for a credit crunch coming through what the banks are going through right now, there's been a lot of speculation about what that could mean to the economy. Is it going to mean a 0.5% hit to GDP? Is it going to mean a 1% hit to GDP?
I would say that I've been in business running Berkshire for 58 years, and I've never found economic forecasts of any use to the company. We got to keep plenty of cash on hand so that people can keep making intelligent decisions rather than those forced upon them. If I depended in my life on economic forecasts, I don't think we could make any money. I don't know how to do it. And people want to get them, so they get them, but it has no utility. When I find one of our companies has hired somebody to tell them what's going to happen in the economy, I mean, they're throwing the money away as far as I'm concerned.
Okay, so years ago, the Economic magazine came up with a report that kind of corroborates with what Warren Buffett says about or said about economic forecasts. And according to that computation, they try to look at the how off some of these economic predictions are from actually observed trends. And what they found out was that if you look from a 2 years leading period to the forecast, you had a 2.8 percentage point variance from what was actually observed. So say on the average, if you look at the predictions from IMF particularly, according to this report by Economic magazine, IMF forecast had a 2.8 percentage point error when compared to actually observed trends in terms of GDP. And the accuracy of this forecast, if you will, actually compares to a 2.8% point variance from observed trend, actually is as good as picking a random number between 2 and 10. Essentially, what the report was saying is that these predictions are as good as tossing a coin, head or tail. It could be anything. Now, what I'm saying is not an indictment on analysts and economists. In fact, the process of coming up with this forecast requires a lot of rigor. It calls to use an extensive experience and professional competence. You have to look at years and years of data. You have to review several records. You have to review several economic variables before coming up with this forecast. So it requires a lot of professional expertise coming up with this prediction. So I'm not saying anything to diminish any of the work or the professional diligence that goes into coming up with this report. All I'm saying is that despite all of this, despite the effort we put in as analysts, as economists to come up with this report, they are often fraught with imperfections. Imperfections in the sense that everything we say in terms of forecast comes from things we already know. Nothing you say as a forecast concerns the future you're trying to predict. Your base is always things that has happened already, things we already know. And as we know, past trends are not guaranteed to repeat in future. And that is why most times these forecasts are often sometimes far from reality. It has nothing to do with the competence of the people who put out this forecast. It just all it has to do with is the fact that we are humans, and as humans too, we have our own biases. And sometimes, if you put out a report, your bias shows up. And most of these forecasts is simply spreadsheets. Whatever you put in is the output you get. So you can have the same spreadsheet and different outcomes at different points in time. So as an investor, my advice would be not to get hung up on this forecast, this economic forecast. Don't get hung up on them, because sometimes it varies from reality. And what you want to do as an investor is to have a sound framework for making decisions, a framework that transcends any economic downturn, transcends different market cycles. So that is what you want to implement as an investor, not paying too much attention to this forecast, because again, most analysts will keep updating this forecast as the year progresses. So what are you going to do? Are you going to change your investment strategy every time there's an update? If you're trying to build long-term wealth, that will not work. And then again, it's important, and this is why you see many of us speak about having a long-term view when it comes to investing. If you have long-term view, these bumps in terms of market cycles along the way will matter less to you, because you're looking at the picture, long-term picture. You're looking at fundamentals. You heard Warren Buffett say he stopped investing in stocks and now invest in businesses. You're looking at businesses that have sound long-term prospects. That becomes your move as an investor. If you move away from these short-term trends, predictions and all of this, you start to focus on more fundamentally sound strategies. And again, you can't overemphasize the need for diversification. Diversification is always very important. If you have a diversified portfolio, you have an inbuilt resistance to some of these short-term shocks. Is there a geopolitical tension? Is there a crash in oil price? If you have a long-term portfolio, you kind of build that resilience you need in your portfolio to navigate these different market cycles. So to the meat of the day, Tesla earnings reports. It was a spectacular performance by Tesla by all ramifications. You can't see that report and not love the company. And this is the surprising thing about Tesla. We've seen the stock is very volatile. So you have some of these near-term headwinds that have affected the company that send the stock price crashing. But the company has stuck to its strategy, day one strategy. There's nothing new, actually, if you've been following this company for a very long time. There is nothing new in this report. This is who Tesla has been all these years. To the report itself, we saw a slight decline in revenue. Revenue dropped by 1.17%, compared to estimates. They posted a revenue of $25.2 billion. But where the company made its mark is in EPS, earnings per share, outperformed estimate by 20%. EPS came at $0.72, 0.72 cents compared to 60 cents estimates. EBITDA came at 4.6 billion, outperforming estimate by 20.05%. It was estimated that they will post an EBITDA of 3.89 billion, but the company ended up delivering 4.67 billion in earning before interest, depreciation, and amortization. And then if you drill deeper into the result, you saw automotive revenue go up by 2%. And this is understandable. At some point, Tesla started to cut prices because we've had headwinds, a lot of headwinds in the EV space. You had higher interest rates, and so people were not getting the financing they needed to buy these Tesla cars. You also had trade wars that impacted demand, particularly in China, and globally, EV demand has struggled. So most EV companies, pure play EV companies, have seen a slowdown in demand over these years. But what Tesla did was to reduce the price of their vehicles. And at the time they took that decision, what most analysts expected was that it was going to hurt their revenue, which from this report you saw their revenue grew just by 2% year on year compared to third quarter of 2023. We just had a 2% growth in revenue. But where the magic happened was in cost. The company delivered in terms of cost efficiency, and you saw that show up in their gross margin. Gross margin went up to 17%. Tesla used to do a gross margin of around 20% gross margin before declining below 15% recently, as we had all of these headwinds affect the company. But now gross margin is growing again, and we expect in the coming months, as the company consolidates on all of its cost efficient measures, we expect the gross margin to ramp up back towards 20%. It's the Cybertruck also performed well within the quarter. According to the report, the Cybertruck is now the third best-selling EV in the United States. And then we saw contributions from self-driving vehicles, $326 million in revenue. The company delivered 462,000 vehicles in Q3, which is an increase from a 6% increase from Q3 2023. In terms of outlook for next year, Musk actually said in the earnings call that he expects revenue to grow at between 20 to 30% for next year. That is below expectations we had 3-4 years ago. But if you have kept track with what is going on with the EV market, you see that if they're able to grow at 20% even next year, it will be a very spectacular one for them. You can't help but to be very excited looking at the performance of Tesla. How did they deliver on this? Really, that is the question. Because there is hardly an EV company in the world that is profitable. I think Tesla, Musk says something like Tesla is the only EV company that is profitable in the world. I can't validate that claim, but if you look at the EV space generally, most of the EV stocks are struggling big time. Rivian, Lucid, Neo, Xpeng, all of these companies are struggling. Their share prices have mostly been down this couple of years. And that speaks to the level of demand we are seeing for EVs. But the unique thing about Tesla is that I don't really see them as a pure play automotive company. Tesla is something of a hybrid between between automotive and software. It's both a car manufacturer and a software company, and that is what has helped the company remain profitable all these years. Tesla has been profitable for a long time now and continues to be profitable. And one unique thing they've done that sets it apart even from other car manufacturers is that Tesla focus on their production plants. They focus on making their production plants a lot more efficient than the likes of GM, Ford, Honda, and the traditional auto manufacturers. Tesla has plants in the United States serving the North American market. They have another plant in Berlin, Germany, serving the Europe market, and they also have a plant in Shanghai in China serving the Asian market. So with these strategic plants, what the company is able to do is to cut down on stuff like tariff. Of course, if you're sending cars from US to China, you're going to pay tariffs. So, but if you already have a plant in China, you're going to boycott those tariffs and other duties that comes with export. So he's able to boycott all of those. And even the trade wars that we've seen between Europe, America, and China, they're able to manage it better. And their plan, they're focused on making their plan more efficient with the sort of technology they have. So the company has positioned itself to be the leader in the EV space, and they're the leader by a wide margin. It's not even close. No company comes close to Tesla in terms of what they have done in the EV space. And then you look ahead, you expect exchange rate to start coming down in the coming months as the Federal Reserve starts to implement rate cuts. As exchange rate goes down, you expect the demand for Tesla cars to go up again as people start to have more access to affordable financing. Because if you want to get funding for a car, you look at the monthly payment, and the monthly payment has interest rate has a consequence on the amount you get to pay at the end of every month. So with lower interest rate, most people will be encouraged to actually get financing for Tesla. And then we finally saw clarity in terms of the cheaper model EVs, which has been the kind of the gray area for investors. Finally, the company committed to delivering on these cheaper model EVs come Q1 2025. And it's going to also be a game changer in terms of the company being able to grow revenue. If they have these cars below $30,000, it's going to actually ramp up their sales. And to date, the company has delivered 7 million vehicles, and that is very, very impressive for the EV market. And then again, you saw what they are doing with the robotaxi. For me, it's like the game changer. The ability to deliver on the robotaxi and their FSD, which is a full self-driving autonomous vehicles, will actually transform a lot of industry, the e-cab hailing industry, and then of course just the whole EV space. If they're able to get the approval, they're projecting to launch the robotaxis come 2026. So it's going to really be a game changer for them, and the company has just positioned itself to be a leader in this distinct space. Speaking of the e-cab hailing business, the robotaxi, the FSD, and then the regular Cybertrucks, their Y model, the Y model, which has been the best-selling EV worldwide. So the company has positioned itself attractively. If you compare their price to earnings ratio with the likes of General Motors, Ford, Tesla would appear expensive at 73.75 currently, compared to GM that has a PE ratio of 5.5 and Ford that has a PE ratio of 11.53. But I think comparing with these companies is just because you don't know which other company to compare them with. Tesla is not, as I said, a pure play automotive company. They're a hybrid company that combines EV and software, which sets them apart. So the sort of stuff you see that could potentially affect the revenue and the profitability of a pure play automotive company is not affecting Tesla. They cut down on price, and yet the company has remained profitable. So basically, they are taking control of the things that is within their circle of influence, and they are attractively positioned. Okay, so if you look at the stock performance in the last 3 years, Tesla has actually underperformed the S&P 500 by a wide margin. In the last 3 years, Tesla has returned negative 21.2% compared to 33.28% from the S&P 500. But with the result we saw last week, the share price went up 23% for the week, and 8.3% year to date. But as I say, the company is positioned to grow their revenue in the years to come. I think we've seen the worst of the interest rate. We've seen the worst in terms of the declining EV demand, especially in China. And actually, sales are beginning to pick up in that region for Tesla. And now that we have in sight the cheaper EVs coming in Q1 2025, I think the outlook for the company is a lot more positive than it was a couple of months back. So barring a resurgence in interest rate, barring a black swan event and let's say an outbreak of a war or stuff like that, you expect this company to continue to outperform. The result has been, the rebound so far has been impressive, and I expect the company to push towards $300 in price. But as I said at the beginning, Tesla is a very volatile stock, and if you're looking at short-term rewards, I don't think this is the company for you. If you're investing in this company, it should be for at least the next 5 years. You're looking at what happens with the lower model vehicles next year. You're looking at what happens with the robo taxi comes 2026. So you're actually investing for the future, not for the immediate. So if you're a long-term investor, this is a stock you look at to decide whether you want to add to your position if you don't already have it, or continue to average down or average up, as the case may be for you. So moving on, the next company is Enphase Energy, and this one actually disappointed a lot. This company has struggled mightily in the last couple of, since last year, 2023, the company has been struggling. The share price actually peaked at, I think, about 334 or $343 at some point, but is down mightily. I think it touched $78 after the earnings report came out last week. Compared to estimate, revenue underperformed by 3.3%. We saw a revenue of $381 million compared to $394 million expected. Earnings per share also underperformed estimate by 16.67%. Came at 0.65 compared to 0.78 expected. EBITDA also underperformed estimate by 7.94%, coming at $116 million compared to $126 million. So Enphase Energy is a leading supplier of micro inverters and battery systems, and they serve the North American and Europe market predominantly. 75%, about 75% of their revenue comes from the US, and 25% comes from Europe. And actually, demand in Europe has been very weak the past couple of years because of interest, and because most of these solar projects are also financed with debt. And because of high interest rates, we've seen a decline in demand, particularly in Europe, which has continued to struggle even for this current quarter. We also saw challenges in the US, particularly in terms of regulation they call NEM 3, a new regulation that came out in the California area, which impacted most of their distributors and installers. In fact, most of the distributors and installers went bankrupt, and then although we started to see changes in this current report, but this is where the decline in demand has been coming from, but year on year, we saw a decline of 30.9% from Q3 2023. Revenue went up by 30.9%, but compared to Q2 2024, there was a 25.5% increase in revenue. So on one hand, they are not at the level of sales they were in 2023, but on the other hand, sales is beginning to pick up compared to the most recent quarter that ended in June. Net income was also down compared to 2023. down 60%. Profit margin also down 21%. And then EPS was also down. So the company has seen all sorts of troubles, but the outlook for them is that by their guidance, revenue will normalize in 2025, and we've seen growth in US picking up, no doubt. But the major challenge they have is in Europe, and we'll see what happens, especially as interest rate cuts starts to become a thing in Europe and America. We expect that demand will pick up again. But the company has one of the best microinverters in the market in Europe and America. In fact, along with Solar Edge Energies, Enphase Energy controls that market in the US because their microinverter is kind of unique. They have most companies have a single unit inverter, one inverter that controls the whole solar panels. So if something goes wrong with one of the solar panels, it shuts down the entire unit. But with their technology, each panel comes with its own inverter. Each panel comes with its own inverter. So if something goes wrong with one of the panels, it doesn't affect the entire system. And that has been their selling advantage in Europe and America. But of course, the demand side is something they have to navigate come 2025. But the company has been struggling, and you look at their share price, it shows up also. In the last 3 years, they've underperformed the S&P 500. The Enphase Energy has returned negative 53.28% in the last 3 years, and then 33.28% is what the S&P has returned, as opposed to negative 53.28% by Enphase Energy. So if you're looking at the current valuation, it appears very cheap. And in fact, of 40 analysts that I profiled, 12 of them have buy recommendations on Enphase Energy. 7 has outperformed expectation. 19 has hold rating on the stock. Just one of the analysts has underperformed rating, and just one analyst is recommending a sell out of 40 analysts reviewed. So if you already own the stock, this price is definitely a price where you want to average down with. And if you want to participate in the solar industry, I think this stock is one that you want to actually look at. Again, you look at the increasing demand for power that is coming with the data centers, the AI data centers, and you want to look at all the companies that are players in that space, because we expect demand to ramp up, particularly driven by artificial intelligence. And then speaking of energy, the next company I'll be looking at is NextEra Energy. Much like Enphase Energy, they've also struggled with demand. And particularly, NextEra had one of their largest subsidiaries, which accounts for about 70% of their earnings, the Florida Power and Light, I think that's what it's called, FPL, Florida Power and Light, was impacted by the Hurricane Helena and Milton that happened in the U.S. in the during this last quarter, which ultimately impacted their revenue. We saw their revenue come below estimate, 7.5 billion compared to 8 billion estimated by analysts. But EPS outperformed estimate by 6.8%. They saw an EPS of $1.03 compared to 97 cents. However, EBITDA underperformed estimate by approximately 15%. EBITDA came out 14.5 compared to 5.29 expected. But as we see, again, most of these power projects are sensitive to interest rate, and NextEra Energy is one of the leading provider of renewable energy in US, in the United States. They have a combined capacity of about 74 gigawatts. 34 of that comes from their project in Florida, and then 34 from renewable energy. So they're a big player in the renewable energy market in the United States, and you expect them to, when we speak about power and the opportunities that comes from the demand from AI and their data centers, most of the conversation has been around Constellation Energy, Vistra Corporation, and those companies. NextEra is one of the companies that has kind of fallen. We don't talk about them as much as we should, but the company expects revenue to grow at between 6.8% next year. But the outlook for them is really artificial intelligence and the increasing demand for power. You expect them to get a slice of that market. Then you look at their share price. Their share price has also underperformed the S&P 500 in the last 3 years. The stock has returned 4.15% only, compared to 33.25% return by the S&P 500. So we can speak about the fact that the market is overvalued currently, if you look at the aggregate market price to earnings ratio. But if you drill deeper, you're going to see some of these names that are trading below the level of the current level of the market's valuation. You're going to see some of these bargains trading in the market. And then as an investor, you want to, as we expect the market to broaden in 2025 and 2026, these are some of the names that you can that can help you diversify across different sectors. One being renewable energy, and then I previously spoke about Enphase Energy and what they are doing with the solar energy sector. Then the next one is Thermo Fisher Scientific. Now we're shifting to medical equipment. Thermo Fisher Equipment saw a flat revenue last quarter. Revenue came at 10.6 billion. EPS improved slightly by 0.57%, $5.28 compared to 5.25 estimated. EBITDA was also flat, 2.65 billion compared to 2.65 billion was the expectation. So if you look at Thermo Fisher is a leading name in what they do is laboratory products and biopharma services. They also sell specialty diagnostic equipment, life science solutions, speaking of reagents, and they serve the North American, Europe, and Asian markets. And this company has also struggled with demand. Demand has kind of fallen because most of these medical projects that require their devices and reagents have kind of slowed down, particularly those working on COVID-related solutions. We've seen a slowdown on most of the COVID-related projects, which ultimately has impacted their financials. We saw revenue down 5% from Q3 2023. Profit margin remained at 15%, the same level as at Q3 2023. And then EPS dropped to 4.27 from 4.4 in Q3 2023. Well, again, this is another name that has underperformed the broad stock market. If you look at the three years performance, Thermo Fisher has underperformed by they have a negative return actually of 8.12% compared to the S&P 500 that has returned 33.28%. Then in terms of price to earnings ratio, currently their current trailing PE is 34.76, and their forward PE ratio is 25.55. So you're looking at another company that I think may not be a high flyer in my opinion, but you expect the demand to stabilize come 2025. So moving ahead, the next company is Verizon Communication. I just rushed through this one. Revenue underperformed estimate by 0.3%. EPS came at $1.19, outperforming estimate by 0.85%. EBITDA came at 12.5 billion compared to 12.4 billion estimated. The Verizon is a leading provider of wireless and wireline communication services. And what I saw from the current performance is actually the positives from this performance actually is the fact that they added 229 new customers and they grew their broadband connection by 16%, which is kind of massive, to 11.9 million subscribers, their broadband connection. In the past 3 years also, this one has also underperformed the S&P. They returned negative 4.87% compared to the 3.28% by the S&P 500. So it's one of the first companies in this sector, the communication sector, to publish their report. This performance is kind of weak. So again, I don't have Verizon myself, and it's not a stock I'm looking to add anytime soon. There are better names out there in the communication sector that one can look at. But in terms of valuation, I think that the company is slightly undervalued. So if you believe the market will broaden to other sectors, this may be a name that you want to look at. Then the final one from the foreign market is Coca-Cola. Coca-Cola actually performed better than estimate. The revenue went up. And came at 11.9 billion compared to 11.6 billion estimated. EPS came at 0.77 cents compared to 75 cents estimated, which was a 2.67 surprise. Free cash flow stood at 1.6 billion, which is actually less, which is actually a decline from the level we saw in previous years. Okay, so coming back home to some Nigerian companies, we also saw Q3 reports, 9 months report from Dangote Cement last week. In the report, they saw a 69% growth in revenue. Revenue went up by 69% from 1.5 trillion to 2.5 trillion. However, cost of production went up by 92%, faster than the growth in revenue. So we saw 92% increase in cost of production. I went from 642 billion to 1.236 billion, which kind of offset the growth in revenue that we saw. Also, we saw finance costs go up by 137%, from 190 billion to 451 billion. This kind of speaks to what Dangote was saying about interest rate being very high and putting a lot of businesses at a disadvantage. And that showed up in the bottom line. The profit after tax only managed to increase by 0.56%, which is not quite impressive. Now, if you drill a bit deeper, you would see the volume of sales. The Nigerian volume of sales went up by 9.5%. However, the export angle, the Pan-African volumes, that is sales to countries like Ghana, Cameroon, and Niger, declined by 1.6%, went down from 8.4 million tons to 8.357 million tons compared to this time last year. But I did mention the fact that the cost of production has increased by 92%, and I think the company is doing something to deal with that. They reported delivery of about 1,500 fully CNG trucks, and the commissioning of 11 alternative fuel sources by the company. So hopefully those should impact their bottom line in the coming quarters, starting from 2025. But it speaks to the general economic situation in the country. Not much in terms of volume growth, but of course, if you look at the fact that they have the ability to increase price, which led to, so volume grew by 9.5%, but sales grew by 60%. So most of the sales growth is not coming from actual much of production, increase in production, but coming a raise in unit price for the company. Okay, the next one up is Airtel. Airtel also saw their H1 2025 report. Everything looked down. Voice revenue declined by 17.8%. Data revenue declined by 7.6%. Inter-segment transfer declined by 12.9%. Other revenue declined by 6.47%. The only positive from these reports came from mobile money revenue, which went up by 12%. However, EBITDA margin also declined from 49% in the previous quarter to 45% in the current quarter. Net profit margin, however, improved to 3.3% from negative 0.5% in the previous quarter. Now back to the earnings report. If you look at the profit after tax, you saw an increase, a 707% increase in profit after tax, and then EPS also increased by 153%. So the Airtel has also struggled because of the harsh operating environment that we've seen in the country. The foreign exchange rate impact on their books has been massive in the past couple of quarters, but it appears that they are dealing better with that. But the worrisome part is when it comes to their core business, revenue is also not growing, which is a worry for a company that operates as a near monopoly, considering the fact that Airtel and MTN accounts for a large percentage of the global communication business in Nigeria. Then finally, Seplat Petroleum. We saw a report last week of the Nigerian Upstream Regulatory Commission approving the acquisition of ExxonMobil assets by Seplat Petroleum. And by this deal, Seplat will now own 40% of 4 oil mining leases as an associated infrastructure, including the Kwai Ibo Export Terminal and 51% of Bonny River Natural Gas. Bonny River Natural Gas Liquid Recovery Plant, previously owned by ExxonMobil. Seplat is one of the stocks that has performed extremely well in the last couple of years. They earn most of their revenue in USD, so they're they have a kind of resilient revenue structure because of the unique nature of their business in the upstream sector. So the company continues to make these solid moves, and we'll see where that takes us to. And so to round up, we're entering a very, very important week. A very important week. We're going to see earnings from some of the 5 of the Magnificent 7 stocks. Speaking of Google, Facebook, now called Meta, Apple, Microsoft, Amazon, and then a host of other companies like AbbVie, Eli Lilly, Pfizer, Advanced Micro Devices, Visa, Chevron, and ExxonMobil. So it's going to be an interesting week. Myself and my team will be on ground to review all of these reports and bring you what we see come next week. Now, if you've made it this far and you've enjoyed this show, I encourage you to let me know in the comment section. It's very important for us to get your feedback, your reviews. Please keep them coming. Let us know what you're enjoying. If there's a specific thing you want us to talk about, do let us know. And don't forget to subscribe and share with your contacts. Until next time,